Let's get to the floor show, and JP Morgan tried to thank U.S. equity strategist Abby Yoder. Abby, it is rather stunning to think that earnings per share that for this recent reporting quarter are up 25% year over year. I mean, this is incredibly strong.
Remarkable, remarkable. And not only that, so coming into the quarter, they were supposed to be 12 to 13%. So that's a really meaningful revision, right? When you're thinking about where we're, north of 20% in terms of earnings growth for the quarter. And this is the sixth consecutive quarter of double-digit earnings growth for the S&P 500. The only other time that we've seen that is coming out of the global financial crisis, coming out of a recession, right? And we obviously aren't coming out of a recession. This is just showing, obviously a lot of it is being driven by tech. Tech is supposed to grow earnings 50% year over year this year. And it's not just the Mag 7 and the Mega Cap. You're seeing it kind of disperse more out into like the memory chip names that we've been talking about. So you are starting, and the median company in the S&P 500 is going to be growing earnings 14%, right? That's up from high single digits last year. So just an overall general improvement that just is really healthy.
When you see a day like today, the SOX for the moment, the semiconductor index is falling right now about 3.25%. But if you look over 2 days, it's had a bit of a struggle here. Do you look at that and say, I'm not concerned about the semis? They are going to do just fine because of the demand that's out there.
I mean, I do think it's an attractive, way to, we don't really get these pullbacks, right? Like it is kind of attractive to see this pullback because it had moved very quickly, right? And there's all this talk and consternation about how concentrated the market is. And it's not even just tech, it's really semiconductors, right? I know Charles was talking about software and how challenged that continues to be. So to see this little bit of a breather in terms of performance isn't a bad thing, right? Like we've seen enthusiasm get really stretched, and there is the fundamental underpinnings that will continue to drive earnings growth for these names. But that said, we did see a lot of momentum in the last quarter.
And is it enough for you to say I'm still in these names?
Yes, for sure. I mean, I think this is a secular trend, and it's not just AI. It's all of these different things. Like you were talking about energy and how that's making this bottleneck even worse, right? And so there are so many different secular trends that are driving what we're calling this kind of infrastructure build out. Like, I don't think 3.5 years into the AI, tech cycle, you would think that still the tech and infrastructure, like the picks and shovels of it, would be the ones still leading. But because we have such a supply constrained environment and the demand is insatiable, you continue to see them win at this point.
What don't you like? Are you concerned at all? We have a lot of big retailers reporting this week, the Targets and the Walmarts and the TJXs of the world. And these are names that give you a real sense of the consumer and his or her sentiment. We just got a pretty good retail sales number rather, but the inflation numbers have been just devastating.
Yeah, I mean, I think to your point, we'll get a lot of information. The consumer-related names tend to report later on. It'll be very interesting, given that they report later on. They also have the benefit of, quote-unquote benefit, of being able to experience higher oil prices than if they reported at the beginning of earnings season. I would say staples is not a sector we like in particular, just given the valuation that you see there for the growth of it, right? It's not particularly attractive when you can look at tech that has a similar valuation and a much better earnings growth profile.
It is great to have you, Abby.